All right, so we're going to get started on the second panel. Now we're kind of looking at considerations once we've had our org meeting. And maybe we'll get started with you, Greg. If you can tell us a little bit about what happens in the due diligence process and what companies should be preparing for before they kind of find themselves in a due diligence scenario.
Sure. It's touched on a little bit on the prior panel, but when I'm advising companies and we're in the lead up to an org meeting, there's a couple of things that I try to have them do so that they walk into the org meeting looking fully prepared. One of those things is getting all of the due diligence ready for examination by the underwriters and by their counsel. And what we typically do is send over the diligence questionnaire that we would send if we were on the underwriter side and say, this is what you're going to see. Let's start pulling together all of this material into a data room. And the questionnaire, the question list is quite long. It's basically everything you can think of from corporate documents, your entire corporate history, your capitalization, key commercial agreements, key licensing, strategic agreements, historical financial statements, and pretty much everything else you can think of. But if you can get all of that pulled together, foldered in a data room, and at the end of the day at the org meeting you say, okay, everybody, we have the working group list. We're going to be sending out email invitations right after this meeting to open up the data room. Then the underwriters and their counsel will walk out thinking, wow, these guys are really prepared. The other thing that Bill touched on a little bit is coming to the org meeting with initial drafts of sections of the S1 is a really good look. So if you can come in with a draft business section, or even an outline, if you can come in saying, here's the shell of, not the business section and MD&A and comp, but kind of all the other pieces, then it shows everybody that you've been thoughtful in the pre-org period, and that you're ready to roll once the process really kicks off.
Great, thank you. So once you've actually filed your first submission, so assuming that you're under the Jobs Act and you filed confidentially, what really happens in that time period between kind of receiving comments from the SEC and when you actually did your filing?
Sure. So everybody's going to do their first submission confidentially. And so you have a roughly 30-day period after the submission and before you get your initial set of comments back from the SEC. Last year the SEC time periods for review were a bit delayed given how crazy the market was and how busy and understaffed they were at the time. We're now seeing more regular kind of time periods, which is 30 days for that initial filing, and typically they try to stick to 2 weeks for subsequent filings. Now, depending on what the issues are, depending on what industry the company is, those timelines may slip a bit. And as Bill noted, over the last year or so, we're not sort of seeing a kinder, gentler SEC, that's fine. This all cycles, but you do have to sort of plan for that timeline. And so things that you can do and that we typically do while we're waiting for comments is address sort of other things that we need to get done as part of the IPO process, like governance documents, like policies, code of ethics, insider trading policy. There's a lot of new policies and charters that get adopted as you move from a private to a public company. And so in the interim, while you're waiting in between comment letters, those are the kinds of things that you can work on.
Thanks. So now we're at the point where we would get our first SEC comment letter. Brian, I don't know if you want to talk a little bit about that process.
Yeah, so as Greg mentioned, it's typically around day 30 that you'll get the comment letter. Very exciting time, right? See how many comments you get, what's the over-under. I'll speak from a financial statement or financial metric perspective, and then maybe Zach and Greg can chime in on the other stuff. But yeah, there's a lot of publications out there on recent trends in SEC comment letters. Certainly for tech companies, one thing you want to be careful of is your non-GAAP disclosures. So your earnings metrics or your key business metrics EBITDA, adjusted EBITDA for software companies, ACV, TCV, whatever the acronyms are these days, just to make sure that they're clearly defined and not misleading. That's certainly questions that I've seen on the tech company side. Certainly on revenue recognition, again, more geared towards the tech company side, but also on certain life sciences companies out there, you may have collaboration agreements, just making sure that you have a very well thought out disclosure on revenue recognition. And a lot of the length of the disclosure doesn't always necessarily correlate with the quality of the disclosure. And that's a conversation that I have with my clients a lot of times. It's, hey, look, we're all practitioners, right? We understand the minutia of ASC 606, right? But you got to tell the story to an investor, and it flows in a nice logical sequential manner that an investor can understand what the revenue recognition policies are. And then I'd say the other one, again, not applicable to as much for life sciences companies, but the determination of segment information and making sure that you're disclosing the right amount of information on a segment basis. That's certainly something that I've seen the SEC comment on. Again, more geared towards tech companies versus life sciences companies.
Thanks. Greg, from a legal perspective, I know you said we're not seeing as kind and gentle of an SEC practice or comments. What are some of the topics that you've seen kind of consistently in the last, say, year or so?
Yeah, I mean, I'd put another plug in for non-GAAP measures. In particular for tech companies, you're trying to, as you're entering into the process, one of the important things that you'll be talking about with your bankers is, hey, what are the key metrics for our business? How do we think about from management's perspective, from period to period? What are the metrics that we follow? What are the metrics then that we're going to want to be presenting to public investors, and is that going to be on a quarterly basis? Is that going to be on an annual basis? And then the lawyers chime in and say, okay, well, are these non-GAAP metrics that are going to require reconciliation to your sort of nearest GAAP metric, or are these not really financial metrics, they're more business metrics that we can present without any kind of reconciliation? And sometimes the lines get a little bit blurred and you have to make judgments, and then you see if the SEC agrees with you. The other thing I would note is if any of your businesses have anything to do with digital assets or cryptocurrency, that is obviously an evolving topic in the industry, and particularly with the SEC. And so they have a lot of questions. They are learning along with the industry as it develops, and obviously they want to be very protective of potential investors, because as it's an area of rapid development, it's also an area where there can be a lot of fraud or things that are misleading, and so there's more time required in the back and forth with the SEC if you have anything crypto or digital currency related.
Great, thank you. Arto is a member of our valuation team, so he was going to talk a little bit about the concept of cheap stock and some of the things that you can do to assess whether you have any concerns with kind of a cheap stock issue prior to the IPO process.
All right, thanks, Jan. Yes, my name is Arto Sen. I'm a partner at KPMG's Valuation Services. I guess for the topic of today, we're going to talk about 409A valuations mostly, but we do also transaction-related valuations, pricing analysis, collaboration agreements valuations for life sciences companies as well. But in terms of cheap stock, maybe I'll take a minute to explain what the cheap stock issue is. For companies going public, it's very common for them to issue stock options to their management, right? There's an incentive role to it. And under the US tax rules, if those stock options are issued at the money, meaning at day one they have zero value, then they will be protected under the 409A terms, and the recipient of the stock options doesn't need to pay any taxes day one. So that's the whole idea of protecting and incentivizing management for the growth of the company and during the IPO process. And obviously one of the key inputs to this process is really to determine what's the fair value of my share, so I can issue my stock options at a strike price that's equal to my share. And to do that, obviously, you will engage a third-party valuation firm, and they will come in. Again, for pre-IPO companies, it's either quarterly or sometimes every 6 months, but there will be an updated 409A valuation that will give the company, okay, here's the fair value of your share, and you can use this to issue your stock options. So this will be a continuous process. And obviously from an SEC perspective, there are a lot of comments around cheap stock, which means they want to make sure that you are not issuing in-the-money options, right? Meaning that when you issue the option, there isn't really an intrinsic value to the share itself, to the option itself. So that's why the valuation analysis supports that, and that mitigates the cheap stock issue. In terms of, I guess, couple hot topics that I've seen recently, maybe I can think of two. One has been around for a long time, and one is a newer, more recent one. One that's been around for a long time is the value progression. That's a typical question that the auditors will ask all the time, or the SEC will ask all the time. So the idea is that the expectation to see an increase in the common stock value of the company as they get closer to the IPO. Right, and then as a result of this, the strike price of all the options being issued to management is also expected to increase accordingly to mitigate any type of cheap stock issues. This is very common. It's been around for forever. This is a very typical question. The other one that's more recent is around secondary transactions. And secondary transactions, just to take a step back, for a privately held company, a secondary transaction means management or an investor has a stock in the company and they decide to sell it to an existing investor or a new investor, but this is outside of a full round of financing or crossover financing. This is either two individuals interacting and they decide on a price to sell their shares, and what happens is that in the past we didn't see as many secondary transactions, and typically companies and valuation firms will just ignore this transaction, say, look, this is one-off, this isn't fair value indication, and move on. Now, more and more, we are seeing more of these secondary transactions, and from the regulator's perspective and auditor's perspective, there is more of a documentation requirement on, okay, how did you consider these transactions? What's the cadence of this transaction? What's the information available to the parties who are interacting in this transaction? How was the price determined in those transactions? It becomes a more involved process. And AICPA, who has the cheap stock guide, basically that's the only guide out there that talks about valuation aspects of 409A. They are actually revising their current guide on the secondary transaction side. So it's going to be a still more popular topic in the coming years, I expect. So
yeah, Jen, I would just add, at least on the audit side, look, I know we don't like spending money on this stuff, but I would say, or how I counsel my CFO clients of companies that are looking to go public is, look, you really ought to consider increasing the cadence at which you're getting 409A valuations leading up to an IPO. I would typically tell them, look, once you're within 12 months of potentially going public, think about getting these 409A valuations on a quarterly basis rather than, I'm sure many of you, depending on the stage of development of your company, are getting them on an annual basis. It just buys a little bit of extra insurance that you're not going to run into a cheap stock question from the commission as it relates to that area.
That's a really good point, Brian. And I think sometimes, in the early stage engagements, we don't necessarily audit the 409A valuations because a lot of times stock comp may be immaterial to the audit. So also working with your auditor to just understand the methodology and kind of the increase in value that you're seeing in the 409As, and we can help you determine if there are kind of squishy points that you may want to kind of consider before you get into the IPO process. So switching gears a little bit, I was thinking that maybe we could talk a little bit about other documents that you might kind of find in the IPO process. So we've talked a little bit about the prospectus and the actual registration statement itself, but what else is kind of involved in the overall process? I don't know if you can speak to that.
Yeah, sure, I'd be happy to, and it's good to see everybody. I'm Zach Cantor. I'm a managing director in the software investment banking group at JP Morgan, based here in Boston. I've been covering the software space for the last 10 years, the last 5 of which at JP Morgan. covering really all parts of software, but especially enterprise application software. So in terms of other documents that get created, so the prospectus itself, it obviously serves a legal purpose, and there's all sorts of data that goes into it and disclosure, but it's also a really important marketing document. And so there's a bunch of different advisors and folks that are gonna have their fingerprints all over it, including the accountants, including the lawyers, including the management team, and also the bankers. And what our job is to sort of infuse some life into the document and to really bring to life the story and, highlight the selling points and, show as much leg as we possibly can that the lawyers will let us do. Because ultimately it is a marketing document in many regards, and all the investors that we're going to meet throughout the process, they're going to go through that, they're going to read it, they're going to be highlighting it and marking it up, and then when we go and do roadshow, they're going to be cross-examining us on everything we said in the document. And so it is an important piece of telling the story, getting the word out, and selling the message and selling the stock. But setting that aside, once we file the prospectus, the next big milestone in the process for software companies is getting ready for the analyst day presentation, which is basically where we bring in all of the sell-side research analysts for a full day presentation. We create this 200-page document. We bring in all of the key business leaders, the CEO, CFO, head of product, head of R&D, head of HR, head of legal, and everyone has their own module to present to the analysts, and basically tell the complete story so that they can take that information back and use it as the basis for publishing their initiating research report. So that's a pretty big undertaking. There's a lot of preparation that goes into it. And then basically coming out of that, we take this 200-page document, we distill it down to the 15, 20, 25-page document, which we use as the basis for the IPO roadshow deck.
Yeah. Very good segue, Zach. So could you tell us a little bit about the roadshow, what that entails, and also how that's changed kind of in the post-COVID world?
Yeah. So, well, it's hard to tell how it's changed in the post-COVID world because, as everyone's probably aware, we haven't done any IPOs this year. The roadshow is basically a 10-day, what it used to be pre-COVID was you'd load everybody up on a private jet, you'd start off in Boston, you'd go see Fidelity and Wellington and all the other big public market investors, you'd go down to the Mid-Atlantic, you'd go to Baltimore, you'd see T. Rowe Price, you'd go to New York City, you'd see all the hedge funds and all the asset managers in New York, then you'd fly to Chicago, you'd go to San Francisco, you'd stop off in Missouri on the way back, and it was this 10 to 14-day roadshow, like you're a minor league baseball player, except on a private jet, and you're going from city to city, just jam-packed days full of meetings. It's an exhausting but exciting experience where you go meet investors face to face, sell the story, answer questions, and at the end of which you go and price the IPO. So that was what it was like before. And when COVID hit, and Brian and I were actually getting ready to do an IPO right when COVID hit, and we had to wait and see what we were going to do. There was this huge uncertainty, like, can we do an IPO in a world where people can't meet face to face? Like, sure, you can do Zoom calls and things of that nature, but for an IPO, investors need to see the whites of the eyes of the management team. You can't do that. It would be sacrosanct to do that. But what we found actually is that, Zoom is actually a really effective and efficient medium for doing IPO roadshows. And so, what we found in 2021, obviously, was that we could be extremely efficient with how we orchestrate the IPO roadshow process, and investors love it because they can tune in for 45 minutes and then go back to the rest of their day. Management teams like it because they don't have to schlep all over the country and go living out of a hotel and flying on a jet, and it makes the process substantially more efficient. I mean, I can tell you how many times we'd be in New York City, we'd be in one asset management firm doing a meeting, we'd have to sprint out of there, get in a car, go around the corner, get out of the car, go through security, get to the next meeting, we'd be 5 minutes late, we'd be in a rush, no one had a chance to eat, so management's blood sugar was low. And now on Zoom, it's much more efficient. So what is the world going to look like in like the post-COVID world? I think it's to be determined, right? I can see us going to a hybrid model where for certain investors like the T. Rowe's and Wellingtons and Capitals of the world, we would take the extra time to go do a face-to-face meeting. But I think for a lot of other investors, it is just so much more efficient to do meetings via Zoom.
Yeah, another thing that fell by the wayside during this time frame, I'm sure there's a lot of folks out there that remember going to the printers, right? Bound or Donnelly, you get fed very well. And I couldn't believe it, Zach, when we did that deal. It's like I do all of this from home, submitting edits on the S1. It was surreal for somebody like me who's been doing IPOs since the late 90s to just be doing everything from your kitchen counter.
Yeah.
So
Yeah.
we'll see.
Absolutely.
You know, I distinctly remember thinking, you can't, you know, not go to the printers. Like,
Yeah.
I mean, how would you get the IPO done? Like, how would you find all the nits? And in fact, like, that was just another sacred cow that went by the wayside.
Perfect. So now we've done our roadshow and we have our pitch book. Can you tell me a little bit about the process? How are we going to figure out what our price is that we want to kind of go out with?
Yeah, sure. So when we start the roadshow process, we go out with a range of prices, right? So this basically tells the street, you know, we're anticipating pricing the IPO, you know, within these two dollar values, and then as we go throughout the roadshow, we start to solicit orders from investors, and as we go, we, the banks, you know, along with, you know, the rest of the advisors that are working on the process, we start to get a sense of how the book's coming together. And what we're looking for is, you know, the overall gross oversubscription, the number of times that we've covered the book and that we feel like we can place the stock with investors. Because a lot of investors, they'll indicate that they want to buy, you know, 1 million shares at the market, but in fact, they're just signaling that they want to participate in the deal. They expect the deal to be oversubscribed. They don't actually want to get filled for their total, what they've offered for. And so basically, there's this, you know, book building process that goes on over the roadshow. And what we look to see is, do we have good demand? At what price levels do we have demand? How much price sensitivity is there from investors? Because there are certain instances where the company is so hot and exciting and we priced it, you know, conservatively, that we're able to raise the price range and we're able to price it above the range. And then there's other times where we price it inside of the range, and still there are times when we end up pricing it below the range. And so it all comes down to, you know, how effectively we sell the story and what investor demand is like and what the, you know, overall market backdrop is like. But basically, over the course of the roadshow, we collect orders, and as we get to the end of the roadshow, those orders get firmed up, and then on the day before pricing, we go through the entire book and finalize everything and land on a range where we can, you know, place all of the stock.
Great. Greg, anything you want to add to that from a legal perspective?
No, I mean, basically from a legal perspective, we just kind of stay in close touch with the company and the bankers and make sure, right, in certain circumstances, if you're raising the price or the total, you know, deal value by, you know, over certain thresholds, or lowering it over certain thresholds, then you'd have to make sort of additional filings, and sometimes it happens kind of at the last minute based on where, you know, where the market is landing. But it's really just close coordination, and we make sure that everything gets done that needs to get done in those last couple of days.
Perfect. So hopefully you've had a really successful price, and at this point you are a public company. So kind of all the fun is behind you, and now you're at the cadence of having public company filing. So Brian, do you want to tell us a little bit about how the financial reporting deadlines change once you're public?
A slide on this, Jen,
Yep.
but it's interesting, building on Zach's point. I was talking to a CFO who's now retired, who had taken a number of companies public. And he was like, this is pre-COVID, so they were doing the road shows in the private jets and, you know, flying around the country. And I think they dropped him off in New York City, private jet was gone, and then he had to stand in line with everybody else taking a commercial airliner back to Boston. So now reality sets in. You're a public company, and you have to deal with the stresses of being a public company. You can see, and you know, we'll pass around these slides to the attendee group, but you can see what the reporting deadlines are. But generally speaking, as a new public company, you're going to require for non-accelerated filer status. So as a result, your 10Qs would be due in 45 days and your first 10K in 90 days. So you do have some time in that first year as a public company. Now, that being said, what do I see in practice? Certainly companies don't want to, at least on the tech side, they don't want to be the laggards compared to some of their peers in terms of when they're filing 10Qs and earnings releases in 10Ks. So you try to get them done as quickly as possible, even though you do have more time. I would say on the life sciences side, generally speaking, because the financial statements aren't as relevant and the finance teams aren't as large, you tend to see them use up that extra time that you would get, which is not a problem. They're not penalized, and most other companies do that. But I think the key message here is, if you've been doing the right things from a preparation standpoint, meeting these accelerated deadlines compared to what you may have been doing as a private company shouldn't be an issue. But you don't want to make this kind of the first time that you have to meet these deadlines. So it's sort of getting into a cadence, you know, that year or 6 months leading up to an IPO. So once you actually have to do this, it's not so much of a fire drill.
Perfect. I know there's a lot of financial reporting changes, and you have to think about accounting and legal changes that you're going to have in your organization once you become a public company. I'll just ask the panel, what are some challenges that you're seeing for companies that you work with? I don't know, Greg, if maybe you could get started.
Yeah, I mean, in the last couple of years, I think one of the challenges that we saw was just that market was moving so quickly and people were trying to get out, go public, and from a hiring perspective, just making sure they had enough people on their sort of finance team who had the right skills. You know, sometimes that was playing catch up, so we saw a lot of companies sort of using consultants to kind of backfill as they were trying to make all the hires that they need. Because obviously once you go public and you start reporting, there's sort of no flexibility, right? You got to get it done. You got to get it done on the timelines. So I think hiring was a challenge. I think we'll see in sort of this next cycle, hopefully people will be able to plan for that and do hiring a little bit earlier.
Zach, anything to add?
No, I think that's a great summary.
Perfect. Okay, outside of accounting, finance, and legal, some of the other considerations now that you're a public company is your board composition. I don't know if maybe you want to talk about some considerations for building that board.
Sure. Yeah, and it really, in fact, it's something to start thinking about, you know, sort of 12 months prior to IPO, because there are independence requirements when you're a public company, and so, you know, your lawyers will help you with that. And some people say, oh no, I have, you know, 5 VCs on my board, so I don't have anyone who's independent. Actually, in a lot of cases, many or most of those VCs will be independent for purposes of NYSE and NASDAQ and SEC requirements, but you do have to go through that analysis. Another key hire is someone to be your audit committee financial expert. So you're going to need somebody who has prior experience as a public company CFO or CEO, or as a, you know, was an audit partner at KPMG, right, or one of the other auditing firms. Someone who has that deep financial reporting experience to lead your audit committee. And then finally, diversity is not only is it important from a, you know, board leadership perspective, so that you have lots of views and backgrounds on your board, it's also something that regulators are starting to focus on, right? So NASDAQ has, you know, adopted diversity standards. California did, and then I think it's may have been overturned in the court system. But that doesn't get past the point that having a diverse board is really important. And so using the time prior to going public to look around, use your network, use search firms if you need to, have a really well-established, diverse board with the right experience and independence for when you are becoming a public company.
Perfect, thanks. Brian, one of the other things we haven't touched upon is now that you're public, we talked a little bit about kind of the timelines from a financial reporting perspective. But what about kind of considerations of getting ready for SOX and when you'll have to actually have your auditors attest to your system of internal controls?
Right. So you get a get out of jail free card, if you will, for your first 10K filing. So there's no requirement to have management attest on internal controls, nor is there a requirement to have your external auditors provide an opinion on internal controls. However, depending on your situation, if you meet the certain requirements, you could find yourself in year 2 having to have the external attestation on internal controls. Typically, you're going to see that in the tech companies where the valuations are a little higher. You have to clear a threshold of $700 million. But what I tell my clients is you want to be mindful of it. Just that sort of measurement date is six months through the year. So for a calendar year-end company, you're going to measure your market cap, or your public float, I should say, as of June 30th. So if you think you're going to trigger that in year 2, it's something you want to get ahead of. And as Greg said, in this environment, it's tough to find qualified internal audit folks. So if you do think it's going to be applicable in year 2, it's something you want to be mindful of. Some of the life sciences companies that are out there, typically what I see is they would outsource that because there's just not as many business processes that impact financial reporting as a tech company. But on the tech company side, you do typically see them hire a vice president of internal audit. So again, it's just something to be mindful of that could come up quickly in year 2 of being a public company.
Perfect. Well, I think we've talked about a lot of kind of the scenarios and the situations leading up to the IPO and through the IPO. So just a generic question for anyone on the panel. What are some kind of challenges or things to avoid? So what have we seen that the people in the audience can learn from of other companies you've seen go through the IPO process?
I'm happy to take a first crack at this. So I think for starters, make sure that you build the right team around you, right? Particularly the right support people in your FP&A function, in your, all of the support people that sit around the CFO, that sit around the CEO, that are going to be incredibly valuable to just getting through the IPO process. And then as a public company, like performing the functions of a public company, all the G&A functions. I think putting that team together in advance, being thoughtful about who are the people that you bring in, is hugely important. I think this is self-serving, but having the right advisors, because people that you can trust, people that are going to tell it to you straight and not just pat you on the back and say everything's going great, because those are the situations where people tend to get surprised and frustrated with an outcome potentially. I think if you think about what are the things that trip up companies when they become public, it's not having a great product. Oftentimes, what I've observed, it's usually not having a great product, having a sharp management team, having a great differentiated sort of strategy or whatever. It's really inability to forecast, right? And that's probably the single biggest factor that's going to derail a newly minted public company. Not being able to meet whatever sales projections you put out there in the market. And so having a really rigorous, thoughtful process around how you think about what your growth is going to look like tends to be a huge factor in determining how the stock performs.
Great, thanks. Greg, anything from your perspective?
Yeah, I mean, one thing that I've found in particular with sort of the larger tech companies, maybe as opposed to some of the smaller life sciences companies, is having someone sort of appointed as a project manager internally at the company, and it's not oftentimes it's not sort of C-suite, but it's someone like a chief of staff or someone like that who can really take charge of coordinating with all of the different departments and people internally, and then work with the bankers, work with the lawyers, and work with, depending on who it is, also coordinate with the auditors to help run a more efficient process.
Great, that's great advice. Any questions from the audience? No?
Just a quick question, maybe to your last point about trips people up or not being able to forecast. I think that was maybe revenue companies, maybe no real revenue for the foreseeable future. If you think about life sciences companies where it's all about the data, and the data will be what the data will be in the clinic. Outside of that, what do you see trips up companies like revenue, biotechs? Again, take data off the table because that's people will be.
I don't know. That might be Sean. Might be a better person to answer that question.
It's missing
when
the
he's coming up.
timelines
Yeah.
for what you're forecasting for upcoming milestones.
Missing timelines. Yeah.
So the question, if anyone didn't hear, was just related to if you're a life science company where the financial kind of reporting is less relevant and you're not necessarily focused on revenue growth projections. It's really just about meeting the milestones and the timing that was set kind of in previous reportings.
I guess the other thing I sometimes see is, for sort of the complicated strategic licensing collaborations, I think the accounting for that is often or can be pretty tricky. So making sure you're on top of that, with your audit firm and amongst your finance team is also important.
Right. Most life sciences companies would view that as sort of a financing transaction, getting into a collaboration agreement. But there can be complications from a ASC 606 perspective, RevRec, and interplay with other accounting standards. I had mentioned that before in my previous remarks. So it's just something you want to make sure that you're on top of prior to filing.
The other thing I would add, this is just answering a separate question, but the other thing I would add is that as a management team, as leaders of a business, as you're contemplating and starting to get ready for an IPO process, have a plan, have like a vision about how you want to tell your story, right? I've been in a lot of situations where we show up, for the first meeting after the org meeting, and there's a blank piece of paper and say, okay, bankers, write the S1. And it's like, okay, we can do that, and we do that, and it'll be okay. But it's better when it's like, the old commercial, like we're like BASF, we don't make the products you buy, we make them better. And so it's really useful if you guys have sat down with a white piece of paper and said, what do we want to say about ourselves? How do we want to tell our story to, de novo investors? And then we'll take that and we'll work it and we'll, pressure test it and we'll make it better. But I think investing the time internally to think about how you want to explain what it is that you do and what makes you special, that time in advance is going to pay dividends later on in the process.
I totally agree, and further on that point, a lot of my clients say, like, oh, we know how to tell our story, we've been doing it for years. Like, this is a really different process, and everything that you say is going to be pressure tested, and so leave enough time to put out what you think your story is and how you tell it and have told it, and understand that that's going to be workshopped a lot and pressure tested. And by the way, at the end of the process, it's going to be so much better and more crisp, but just appreciate that and be willing to engage with everybody in that process.
Great. Okay, we're going to take a quick break. We're going to have coffee outside, and then we will reconvene for a market update, where we'll have JP Morgan and NASDAQ give us a little bit about the specific market conditions currently. Thank you.